Hi everyone, my name is William Jiang, and my teammates are Peicheng, Vivek, Yuyang, Ethan, and Aashav, and we're here to introduce you to cryptocurrency derivatives today. Talking about our today's agenda, contents today we're going to cover are product overview, recent news, risk and return characteristics, past performance, pricing model, trading strategies, and business rationale. So what is a crypto derivative? A derivative in general is a contract or product whose value is determined by an underlying asset. Currencies, exchange rates, commodities, stocks, and the rate of interest are all examples of derivative assets. The buyer and seller of such contracts have directly opposed predictions of the future trading price. To earn a profit, both parties wager on the underlying asset's future value. Derivatives in cryptocurrency can be traded on both centralized and decentralized exchange platforms. Cryptocurrency derivatives exchange can be used by exchange owners to reach out to additional investors. A crypto derivative trading platform is more flexible than spot margin trading and gives you access to markets that would otherwise be inaccessible. Crypto derivatives work like traditional derivatives in the sense that a buyer and a seller enter into a contract to sell an underlying asset. Such assets are sold at a predetermined time and price. As such, derivatives do not have an inherent value, but rely on value of the underlying asset. For example, an Ethereum derivative relies on and obtains value from the value of Ethereum. Crypto derivatives also facilitate market liquidity, impacting the ease with which traders can open or close positions. In a liquid market, there is typically less risk because there is always someone willing to take the other side of a position. Take perpetual contracts, for example, wherein shorts and longs pay opposite positions based on the funding rate. A liquid market, therefore, attracts more investors and traders. Transaction costs are lower as a result. Talking about different types of crypto derivatives. The most common types are futures, options, perpetual contracts, and swaps. A future contract is a legal agreement between two parties to purchase or sell an underlying asset at a specified price and date in the future. The contract is directly executed on the regulated exchange. An options contract gives a trader the choice, but not the duty to purchase or sell an underlying asset at a defined future date and price. Perpetual contracts are not like future or option contracts, whereas they have no expiration or settlement date. Under some circumstances, traders can keep their positions open indefinitely. And the last type is a swap contract, which is a contract between two parties where they agree on exchanging cash flows at a later date according to a predetermined formula. So how to trade crypto derivatives? Taking the example of Bitcoin futures, the first thing a trader needs to determine is the contract's duration. Exchanges for crypto derivatives usually offer weekly, bi-weekly, quarterly options, and a lot more. For example, a weekly trade of a Bitcoin contract with each contract amounting to $1 of Bitcoin priced at $10,000 would require 10,000 contracts to open a position worth 1 Bitcoin. And then the traders can either bet on the price of Bitcoin increasing or decreasing. In either case, the exchange platform will match the trader with someone who went the opposite direction in terms of betting. When the time comes for the contracts to be settled, one trader will need to pay up depending on whether the price of the Bitcoin has gone up or down.
So in recent news, in March 2022, Goldman Sachs started offering cryptocurrency options. So this is basically a non-deliverable Bitcoin option that basically pays out in cash only. This is big news because this is the first time that a large or major US bank has made a crypto derivative trade, opening the door for activity, liquidity, and stability in the market, basically meaning that as more banks get involved, this can be a flourishing asset class for crypto in general. In more recent news, in April 5th of this year, there's this article that came out saying that computers can push out brokers in the exchange marketplace because the way that modern cryptocurrency exchanges work is that they use automated margins and clearing, meaning that they're using your crypto assets as collateral meaning that they can kind of clear and maintain the margins automatically, which basically pushes out the old system of having brokers to push in a margin call for you and maintain the margin for you. This is important because now as you have automated clearing, you can have platforms that are open 24/7, and that reduces the barriers to trade and overall can increase price discovery and sort of transparency across the market. Also in April of this past year, there's this company called Falcon X that launched regulated crypto derivatives for institutional investors. Basically, this is big news because now Falcon X, with this move, becomes the most comprehensive prime broker for digital assets in the marketplace. And now their clients can now use their platform to enter into crypto forwards, options, and swaps. This is important because as an institutional investor, you have a way to easily and reliably get into this market. And they also offer complete digital asset management on the platform as well. And last, more recent news is in the booming space of NFTs, people are thinking about how to kind of hedge that downside risk going forward. So this is for small scale investors, large scale investors. One thing they can do is trade futures for crypto on the NFT itself. So for example, if I buy a NFT on OpenSea, which is a Ethereum platform, I can trade an Ethereum future to kind of hedge that downside risk. And the amount that you would hedge depends on the ratio that you're using to cover that risk on your NFT portfolio. And another option is by using Ethereum put options on certain exchanges like Deribit.
So now I'm going to introduce you guys to the risk characterizations of the crypto assets. So the first risk, which is the very obvious risk, is the volatility risk. So the price of cryptocurrencies fluctuates dramatically and constantly. The cryptocurrency trade or balance could surge or drop suddenly. And there's a possibility that the price of the cryptocurrencies could drop to zero, which is really not the case for stocks and other traditional assets. So for example, the Squid coin, which was a token inspired by the Netflix program Squid Game, that promised to be used in an online pay-to-earn game, dropped to 9 cents from $3,000 within just a few days, making it essentially worthless. And of course, that's very, very bad news for the investors. The second risk is the business hours risk. So unlike other financial products, such as stock markets or bond market, cryptocurrencies trade 24 hours a day, 7 days a week. So there's really this concept of business hours in the market. Thus, the investors have to constantly pay attention to the market, and they can suffer a serious financial loss after just one night without monitoring the market closely. The third risk is the liquidity risk. So there is a possibility that the trades cannot be settled and may be difficult to settle, or just maybe you have to trade it at a significantly worse price depending on the market situation or the market volume. And also liquidity could also vary from country to country, even if it's the same asset, such as the Bitcoin. It could be very, very liquid in the United States, while it's very, very illiquid in Japan. So that makes individuals exposed to institutional investors who are constantly looking for arbitrage opportunities. The fourth risk is the cryptocurrency network risk. So cryptocurrency transactions, which is actually transaction authentications done on the blockchain, will be held for a certain amount of time until adequate amount of trade confirmation have been received. So there is a possibility that your transaction may be canceled on the blockchain. The fifth one is the crypto theft and hacks. So it is the literal meaning of the risk is basically just the literal meaning, because the cryptocurrencies, as we know, are often held in a digital wallet, and they're also traded digitally. So cryptocurrencies are particularly appealing to cyber criminals because of their online dependence and anonymously. So there are a variety of phishing attacks that can be used to endanger the investors' digital wallets. And finally, the last one is the decentralization, which is obviously the attraction of cryptocurrency in the first place, but that also could pose potential risk for the investors, because the cryptocurrency transactions, unlike other traditional assets, they're not backed up or mediated by a financial institution. So its decentralized nature makes it very difficult to pinpoint the correct entity which to file a transaction dispute. So the cryptocurrency market is essentially very much like a Wild West. So that is also a very big risk. Now we move on to the return characteristic of crypto trading. So one of the main questions that we're trying to answer is if there's any similarities between the return characteristic of a crypto asset or the traditional assets. And in 2018, a research at Yale University, which focuses on the three main five cryptocurrencies, which are Bitcoin, Ripple, and Ethereum, they concluded the following result characteristic of cryptocurrency returns. So it says the weekly returns is 3.79% with a standard deviation of 16.64% higher than traditional assets. So for example, the weekly mean return on Bitcoin, so this percentage is for the Bitcoins, and the Sharpe ratios at the daily and weekly levels are around 50% and 70% higher on the traditional assets. And at the monthly level, they are pretty much comparable to those of the stocks. So even though this research was published 4 years ago, it is still very relevant in today's market. So one of the key return characteristics of cryptocurrency is the high volatility, making it very distinctive from other asset classes. So the research also points out that the return of cryptocurrencies has very little correlations with other assets. So they studied the exposure of cryptocurrency returns to major currencies such as US dollars, Canadian dollars, euros, and etc. And this is to test a popular belief that cryptocurrency may serve as another medium for exchange. So all of those, although like the major currencies, the cryptocurrencies strongly co-move, they find the exposures of all the cryptocurrencies to the traditional currencies are very small or just statistically not significant. So in general, the research concluded that the risk-return trade-off for cryptocurrencies is distinctive from those of the stock currencies or any precious metals or any other traditional assets. So that is the main takeaway for the return characteristic.
So because crypto derivatives are similar to that of equity derivatives, the seller of a crypto derivative can benefit in many different ways. As we learned in class, sellers of contracts receive a premium for entering the contract. So the seller of the crypto contract would make money on that premium collected and is open to profit when that premium exceeds the discrepancy in the strike price and the current price at expiration. Because of the volatility of cryptocurrencies, the premium on crypto derivatives can be very lucrative compared to the average equity derivative. Additionally, the seller of a crypto derivative can use typical equity option strategies like a cash secured put to make money. In this strategy, the seller agrees to receive a premium with a promise to purchase the underlying crypto if it is below the strike price by expiration, using cash as a collateral for the purchase. This strategy would allow the seller to either purchase their crypto while being paid a premium or benefit solely from the premium if the price remained above the strike.
So as William just previously talked about, there are three main products in the derivative market, which is the option contract and the future contract, and also the perpetual contract. So here, for the past performance, I will mainly focus on the first two type of products, the options and the futures. Next slide, please. So in 2020, the trading volume for the option market accounted for just 0.23 of the total trading volumes, or slightly more than $77 billion. In 2021, however, the option market shares rose to 0.41% with an annual trading volume of more than $460 billion. And in terms of the premiums the traders and also the investors have encountered, the total amount of Q1 premiums in 2021 reached $5.4 billion, which is 2.58 times more than that of last year. In addition, to the trading volumes and also all the premiums, we also have to look at the volatilities. As we know, the risk and returns are highly tied to each other. So overall, we can observe that in the year of 2021, there is a declining realized return. And also, as for the institutional option investors, their strategies are primarily focusing on the sell side and time value strategies known as the theta strategies. The theta strategy is very sensitive to realized volatilities. And for realized volatilities, it actually it indicates the actual performance of the market. And there are another type of volatilities, which is the implied volatilities. Those volatilities are a subjective estimation from all the investors. And as the gap between the implied volatility and also the realized volatility increases, there is profit margins for both investors, maybe, and also the sellers for this option. And in the year of 2021, as we can observe, the realized volatility has much higher in value compared to the implied volatility, which makes the sellers of the option a great and desirable return for them. And the fact above means is that the returns in the option market tends to stabilize in the year of 2021. And due to the significant decline in the realized volatilities, there are fewer and fewer situations of market volatilities, realized volatilities, to exceed the expectations. So such phenomena and such situations just guarantees the profits provide to the investors is more stable and can provide more stable cash flows to them as well. Next slide, please. As for the futures, it was more of a larger market compared to the option market. And in 2021 quarter, the first quarter in 2021, total trading volume is $2.07 trillion, in which accounts for approximately 6.7% of the total market volume. And the future contract compared to the options and the perpetual contract, it's more of a hedging tool that used to as a risk hedging or hedging tool for the regular and quantitative allocations. And it has become a routine operation for professional investors and institutions. And on the other hand, options are widely used by those professional investment groups in various combinations of bullish and bearish strategies to hedge against future risk as well. So as you can see in these two markets, there are forces that are pushing them to grow kind of like on the parallel path. And so on the future market and the crypto asset exchange, such as like Binance and FTX, OKEX, and then future exchanges such as CMEs, the basis level for the Bitcoin future contract reached over 25% at its highest in the Q1 of 2021. It indicates that the entire crypto asset industry has considerable and stable expected returns. And in the absence of credit risk, as long as the spots are held, more than 20% of the annualized return will be got by selling those contracts.
All right, so I wanted to talk a bit about crypto derivative pricing models. So as Chu had stated a few slides ago about risk characteristics, there's a lot of different risks involved when we're dealing with crypto derivatives. So rather than having a regular Black-Scholes model, we want some kind of model that helps capture things like kurtosis, skewness, and volatility clustering as well of the underlying derivative security. So we want a model that has a bit more complex volatility than a Black-Scholes model. So in a Black-Scholes model, we just have a singular value for standard deviation, which is just like a sigma. But in this model, we want something with more depth. We also want something that models jumps in returns and volatility. So we want to be able to model cryptocurrencies that randomly jump around in value as well as in volatility. So I did a bit of research, and a similar model that's being used nowadays for pricing cryptocurrency derivatives is known as the SVCJ model, which highlighted in red here is pretty similar to a Black-Scholes model. So here we notice that the return on the stock is modeled using a noise and a drift component, but in this case, the noise component has a bit more complications. So we see like a square root function involved as well. And additionally, we also tack on this jumping function. So here, ZT and NT are fixed and randomized jumps. Usually NT is modeled with something like a Poisson distribution, but basically this gets added on to show how randomly volatile the underlying asset is. And this more complicated model helps explain how randomized cryptocurrencies are, especially when we need to price derivatives corresponding to these kind of things. In reality, we wouldn't use these formulas. We would obviously have to use some kind of discretization method like a Monte Carlo simulation. So what we'd have to do is calibrate these different values like kappa and theta. There's like mean reversion coefficients. So once we have all those set, it is easy to figure out how our return of our stock is being modeled. And this kind of leads to how volatility is skewed, especially in terms of cryptocurrencies. So the graphs here are kind of blurry, but basically they're showing how implied volatility is different across options on Bitcoin derivatives. So on the left, we have like a volatility smile. We notice that the implied volatility for deep in the money and deep out of the money options is really high. And that leads us to wonder like why this is happening. And there are several explanations. The main explanation is that investors think that the price of Bitcoin is going to go really low or really high, and they have higher demand for these in the money and out of the money options. And that leads to these kind of volatility smiles. On the other hand, like on the graph on the right, there's volatility skews as well. So we notice that on the right-hand side, the IV is really low compared to the left-hand side. And the main reason is that investors are more interested in these lower strike price options. And we notice that that IV is way higher than out of the money options. So kind of shifting gears, I wanted to talk about two different trade strategies that you can actually use with regards to crypto derivatives. The first one is a cash and carry model. So suppose a cryptocurrency is worth $100. And then suppose I find a corresponding future on that crypto option and it costs $102 for delivery. So what I would do now is I would short whatever's expensive, so the $102 future, and I would go long the underlying, so $100 long of the cryptocurrency. And at maturity, I would have to deliver the underlying since it's a future contract, and that would cost me $102 minus $100, which is $2. So the thing here is that we're basically exploiting this difference between the underlying price and the future price, and that nets us a $2. So fun fact is this actually happened a few years ago when Bitcoin was super volatile in 2019 and 2020. A lot of investors locked in these 40% gains on crypto futures by shorting futures and going long the underlying. The main issue here is that you may not always have the capital necessary to go along with this kind of strategy and make a lot of money. And you would also have to find expensive futures as well. So another strategy that's commonly used is stat arb. So we look for cross correlations and co-integrations of different assets which are related. And once we do find a related pair, we go long something that's undervalued and go short something that's overvalued. And once that's done at maturity, we would close our positions. We expect these two paired assets to kind of mean revert in value. So like the gap between them closes, so you make money off the initial spread.
So as a hedge fund or a large scale investor, what is the business rationale here? First, let's consider the three main use cases for cryptocurrency derivatives. The number one that we can say is, as Vivek just mentioned, it's basically like protecting your portfolio from like downside and unexpected risk and volatility in the market. Number two is diversification of your crypto portfolio. So you may hold, just straight Bitcoin, Ethereum. You may hold NFTs. You may hold other products. So you want to diversify as much as you can, and maybe even protect that downside as well for your whole portfolio. And the third one is basically speculate on price changes on the underlying assets. So these are very derivatives are typically highly leveraged. So you can put a very small upfront margin, and then also make large scale returns. So who should be using these derivatives? So from our point of view, it may be useful for large scale investors and people who have a lot of capital on hand. But we think that it's more likely it's safer and a smarter move to use it as a hedge than a speculative position. This is because we think that in crypto and especially in derivatives, it's still very early, and these markets are immature and highly volatile. So it would be irresponsible as a investor to kind of speculate on margin without a system for accounting for the systemic and systematic risk associated with crypto as well as its derivative markets. But with this comes one caveat, and we think that typically like these hedge funds or your hedge funds may be very, very large. So a relevant allocation for you may be a large amount of money still for a regular investor. So if you can put a couple $1 million into derivatives and speculate, it can really maximize your returns in a given year. So for example, with 2020, the market has a really the stock market has a very big downturn seen in crypto. But if you're able to kind of capitalize on short or put options or going short on futures, you can kind of save your entire portfolio or your clients' money. So we think that it's favorable for these large investors who have a large risk tolerance, a ability to allocate a small amount, but still have that be a large amount of capital for anyone else. And overall, we say that we would not recommend this for investors who are investing for retirees or people who don't have a high risk tolerance. But overall, we think that it's a useful tool, but one that one should be careful with, especially because it's still so early in this market. So with that, we just want to say thank you for listening to our pitch, and we would welcome any questions that you have. Thank you.